All right, well, the TSX has at least shown up for the big equity rally that we've seen south of the border. It is positive now in 2024 and flat for the year as it looks towards advancing to a two-year high. What's it going to take for the TSX to start putting in some meaningful outperformance from here? We've got Sam LaBell, portfolio manager at Veritas Asset Management. Thanks so much for joining me, Sam.
Thanks for having me.
Well, what is it? Do we need to get a bunch of AI companies together and fast on our index?
It wouldn't hurt, but
yeah.
I mean, the TSX in the global context, we're not doing too badly, but against the Magnificent Seven, obviously that looks very different performance. If you took the equal weighted S&P last year, it was only up about 13%. TSX close to 12. So it's not that we're underperforming, it's that those seven really are outperforming.
Right. Which
carries its own risks. And I think if you're looking to diversify, coming back to Canada is not such a bad idea. Although we do have some caveats on certain sectors that the consumer in Canada is obviously facing headwinds. We like stocks here in Canada that have a global outlook because we do see some pockets of strength in the global economy and some expansion there. And there's opportunities.
Let's talk about that. Is that, and talk about whether those opportunities are in two of the heavyweight sectors, energy and materials. Materials have been a big pain point for us this year.
Yes, and I think one of the challenges here is that we expect rate cuts, but we don't know who's going to cut first and when they're going to cut.
Yeah.
So if Canada were to cut first and the Canadian dollar would weaken relative to the U.S. dollar, the U.S. dollar strengthening would be bad for materials. So there's a bit of interplay there about when are the cuts coming, how are they coming, and that's, I think, weighing on materials. There's also been some challenges globally just with costs and getting volumes consistent. So operations is always a risk when you're taking a material stock in your portfolio. So you have to really look for the long term. And so that can be difficult when you're looking at the daily gold price going up and down.
So then where do you sit on that? Are you taking up exposure because you're taking a long-term view?
We like wheat and precious metals, for example. We like the streaming model. You don't take the operational risk. You get a top-line royalty. There is an alternative minimum tax coming in this year, which they'll have to talk about and disclose. And everyone knows it's coming. It's kind of priced into the stock, but we don't think it has as dramatic an effect as people are expecting. That'll start to hit probably in 25. But we like that idea of taking the top line royalty. We think gold prices are on the way up. And so it's a good place to be.
Industrials are actually a very influential sector on the TSX. One name that's part of that group is Air Canada. And we referenced that it's moving up today because of this halo that's coming from American Airlines and its outlook. How do you think about Air Canada? Because it's Canadian, but it also kind of flies all over the world.
So when you're investing in airlines have been a notoriously bad sector, as everyone knows. Warren Buffett obviously called it out many times, but I think what you need to do is look at the secular trends that are going on in the airline business. You want to invest when capacity is constrained, when demand is growing, and the competition, therefore, is a little bit advantaged because there's less capacity than the demand side. So what's happening a lot in the U.S. is that people have planned for this rebound and have ordered planes, and there's a lot of capacity growth built in. The first one out of the gate was Delta Airlines, and they were forecasting about 6% capacity growth versus 3 or 4% demand growth. So that creates a competitive dynamic where everyone's trying to fill their seats. The yields come under a little bit of pressure. So what we're seeing here today is, yes, they beat top and bottom line, but they were down from where they were last year. Yields are down. The load factors are down a bit. So there is competition here eating into pricing. What we would distinguish the Canadian environment is more of a duopoly, and the capacity is far more conservative. The capacity growth that's planned out is a lot more conservative. So you have the advantage that the two airlines are not going to go as hard at each other on pricing, and demand is holding up. We think that's a long-term trend.
And yet, let's take a 5-year look at the stock, which shows that it has not come anywhere near recovery. And I don't know that that's what you're betting on, because there was a lot of discussion going into the pandemic about what is this stock doing at these levels. But they're, record revenue. They've got a lot of things working for them, capacity, pricing power. There's still demand out there. What is the penalty on this stock?
So in the airline business, it was always about the business traveler. You make a lot of money off business travelers. You pick it up with leisure travel. It's nice to have, but if you can get that business travel and compete in that market, that can make a third or higher of your earnings. So that part of the business hasn't recovered as quickly. It's still coming back, and we're seeing signs of that in the U.S. They're a little bit ahead, I would say, of Canada on the curve of business travel returning. And so that's a premium part of the business that hasn't quite gotten back to pre-pandemic, but it's on its way up. And we look for things where there's a problem that can be resolved, and there's signs that there is actually progress on that problem, because that can be sometimes the best returns you can get, because people are still pricing in that the problem will persist forever and there's no improvement. So your biggest risk is when you have the best case scenario, it's already priced in and there's nowhere to go. If they disappoint, the stock goes down. Tesla is a bit of a case there. Like, they can't beat having 100% market share, and seeing that decline is obviously less impressive as the years go by.
Let's apply that schema of are there problems that we can solve to the bank group? Because the last time I spoke to you, you were bearish the banks. That was a trade that worked out well in 2023. We know what the problems are. Now that we're through earnings season, coming up on another one, are you getting any confident that the banks are getting a hold on their laundry list of problems?
So it's more the client of the bank. We have very well-run banks. You know, obviously we've got a reputation for having really well managed all the crises that have hit in the last 20 years. But the key thing here with the Canadian banks is that there's still a lot of pain to come, and it has to do with the mortgage rollovers. As mortgages roll over, the debt service ratios in Canada are at 25-year highs. They're at kind of in the red zone. They're comparable to where the U.S. was pre-financial crisis. So there's no more room to give on the Canadian consumer. And so as a result, just the rollover of the mortgage book to the higher rate that we're currently paying, that eats into consumer spending. So that can trigger defaults. It can trigger credit losses. Typically, you want to invest in the banks when the credit losses have been booked in. So at the peak of credit losses, that's the best time to get in banks, because at that point, the earnings have been depressed by the most possible. The multiples have contracted by the most possible. We still don't think we've hit that peak credit loss rate. And so we're not saying they're terrible investments. We've backed away from our exposure to banks this year.